In 1990, a hedge fund manager pleaded guilty to illegally destroying 86 acres of protected wetlands on his Maryland Eastern Shore hunting estate with 1,400 cubic yards of gravel without a permit. He was ordered to pay $1 million fine and $1 million in restitution to the National and Wildlife Foundation, and by pleading guilty, avoided a possible 1-year jail term for violating the Federal Clean Water Act. The hedge fund manager I'm referring to is the legendary Paul Tudor Jones. Jones was born in Memphis, Tennessee, September 28, 1954. His father, John Paul Jones, practiced transportation law from an office located next door to the Daily News, a publication his family owned and operated since 1886 and where Jack Jones was the publisher for 34 years. Jones went to an all-boys elementary school before attending Memphis University. An all-boys school, good luck trying to get me to go to a school where there's only one gender. Anyway, Jones then went on to the University of Virginia, and check this out, he was a welterweight boxing champion. I always knew that deep down inside, Wall Street nerds were beasts. While at the University of Virginia, Jones was the president of the Sigma Alpha Epsilon fraternity. Jones was a hard-working young man, clearly seen in the fact that he paid for his tuition by writing for his family's paper under the pseudonym Paul Eagle. After he earned a bachelor's degree in economics from the University of Virginia in the 80s, the prestigious Harvard Business School accepted Jones, but like the rest of us, he chose not to attend. Okay, maybe not like the rest of us, but you get the idea. After graduating, Jones' cousin William Donovan Jr., the CEO of Donovan Enterprises, sent Jones to talk with commodity broker Eli Tullis. Tullis represented some of the largest cotton traders in the world. Tullis hired Jones and mentored him at the New York Cotton Exchange, but Jones was still young, and on one night after partying in New Orleans, he fell asleep at Eli Tullis' desk, which got him fired, obviously. Fortunately for him, everything in life happens for a reason. Before he got fired, Jones had opened up his own hedge fund, Tudor Investment Corporation. Tudor Investment Corp is the classic 90s Wall Street hedge fund, in the sense that the success of the hedge fund entirely depends on the CEO's ability to outperform the market. With that said, Tudor's investment philosophy is a mix of global macro plus technical analysis. Yeah, I know most people in finance think technical analysis is a curse word outside of Wall Street bets, but if it works for you, it works for you. Tudor puts an emphasis on momentum factors driving markets. In 1987, Jones bet against the stock market, a bet that earned him a 125.9% return and $100 million in profit after fees. Today, we know the 1987 crash as Black Monday. In 1990, as the Japanese equities bubble was bursting, Jones returned 87.4% through shorting the market. 4 years after this massive win, Jones paid a fine of $800,000 in 1994 to the SEC, the second highest fine at the time, to settle allegations of violating the uptick rule that prohibits the sale of a borrowed stock while the stock is declining. Jones' fund built a large position across 27 of the 30 Dow stocks as part of a married put strategy. Over the 2000s, Tudor Investment Corporation's returns slowed down, a deliberate move by Jones to trade more conservatively. Tudor's Investment Corporation has an AUM of $12 billion, making it one of the most successful hedge funds. Forbes magazine estimated Tudor's personal net worth to be $5.3 billion, making him the 34th richest person on the Forbes list and 7th highest earning hedge fund manager in the world.